welcome to another financial analysis video with myself, Moe Damin, and Ted Wayman. So today we're going to be looking at Howden's Joinery Group. Now, the purpose for the show is this is an education platform to help you improve your financial acumen. So if you want to get better at business, then you've got to understand the language of business, which is finance. And we help you by analyzing the financial statements of famous, well-known businesses from all around the world. So today, like I said, we're looking at Howden's Joinery Group. Now, a bit of background about Howden's Joinery Group. They're essentially they're a kitchens. They provide kind of kitchens and joinery products to the trade. So what I mean by the trade is, construction workers. So they don't necessarily sell this directly to consumers, but they do sell this to construction workers and businesses, etc., who then fit these things in for you and I in our homes. And by joinery, we're talking about things like doors, flooring, etc. Now, this is a UK-based business, and they're also a FTSE 250 business. So essentially, they are, in terms of market capitalization, the biggest 250 companies on the FTSE exchange. We're going to be looking at the share price of the business, but before I do so, this company is a request from two of our viewers, and stick around towards the end because I will show you how you can make your request for a company that you're interested in, that you would like us to analyze for you. So Dread Pirate and Charlie, here is your video. There's a bit of context that they've both included in there, which Ted will include in his analysis and reference to. We're going to look at the share price as well. We're not giving financial advice here, but it's always interesting to look at the share price and to look at how that kind of connects with the financial statement and the history of the business and the potential future for the company as well. So if you invested back in 1993 when they floated, you'd be sitting on an increase of 359%. Certainly not the highest that we've seen, but it's not bad either. If you invested 5 years ago, you'd be sitting on an increase of 35%. And if you invested a year ago, you'd be sitting on a decrease of 33%. So definitely some changes happening in the last 1 to 5 years. So stick around towards the end. We're going to look at that in more detail. So without further ado, over to Ted to run through the financial statement and kind of almost teach you and show you how to analyze the financial statement of a company like this or any similar company in that industry as well.
Thank you very much, Moe. Good to see you. Welcome back to all of our subscribers. Welcome to our viewers. If you are a new viewer, then obviously please do like, share and subscribe. Welcome to the Dread Pirate Buffett, who I assume is named similarly to the Dread Pirate Roberts, that famous pirate from Princess Bride, I think it was, and obviously that was then passed down through each subsequent pirate. Anyway, we're not going to get stuck into Dread Pirate Roberts and so on and so forth. Here are Howden's annual report and accounts. You'll notice it's for 2021, so this will be the year ended December 2021. We're recording this in November 2022, so quite out of date, and the new accounts will be out quite soon. And if any of our viewers can tell us, Moe and I were trying to work out why these guys have a chicken as their logo. So if you know the answers to why they have a chicken as their logo, please do tell us. So Moe gave you a little bit of background as to who these guys are and what they do, and here's a little sort of outline as to who they are. It's a kitchen supplier, so it's the cabinets and the handles and the kind of all those kind of have those soft closure in your kitchens, all very exciting. So these guys supply it to the trade, to Magnet and these kind of guys at Wix, and then Wix will then sell it to you. So lots of information about who these guys are and what they do, but we are going to whiz through that, and we're going to get down to the kind of the key numbers. So here we go. Here are the numbers. So we're down on page 176 of their accounts, looking at their consolidated income statement. We are in millions of pounds. So you can see here that their turnover is just over 2,000 million. That's basically just over £2 billion. That's a lot. Okay, so these guys, you know, I mean, that's a phenomenal amount. So £2 billion of turnover, significantly up, 35% increase on the previous year when it was 1.5 billion. Cost of sales, I think, is really interesting, is actually pretty low. So these guys, you know, they're making that, you know, their gross margin is 60%. So every time they sell a, I don't know, you know, a bit of wood, you know, joinery, when they sell a bit of wood to Magnet, it costs them, if they sell the piece of wood for £1, it only costs them 40p. Now you think Magnet are then going to make a further profit by selling it to you. So actually, you know, you're paying quite a lot for your kitchen. The actual physical cost of that kitchen is really, really low. So these guys are very, very profitable, which I have to admit is you know, you know, eye-opening. I have to admit, I had no idea. I thought they'd be at a slightly lower margin. They've got some overheads. You'll notice that the selling and distribution, there'll be a lot of distribution costs in there. So, you know, getting it onto trucks and so shipping it around and shipping it onto boats and all that kind of stuff. And then the admin expenses will be things like, you know, the HR team and the finance team and facilities and IT and all that kind of back office stuff that we've got. But still, the operating profit, £400 million, is it's a 19% operating margin. So for every pound they sell, they get to keep 20p. There's a little bit of finance costs, but, you know, really nothing to speak about, which means that we're probably not going to find any debt on their balance sheet. And because they're profitable, they are paying their taxes, which is good. And therefore, they end up with a profit of about 315 million pounds on turnover of just over 2 billion, which is a 15% net margin. 15%. I think a lot of companies out there would be very jealous of a 15% net margin. So that is really, really high. Certainly in my book, I'm surprised that they can operate at such a high margin. And maybe if you work for Magnet, you probably want to get your negotiation boots on, because it looks like you're paying quite a lot for what they are supplying. But maybe there's nobody else out there who can supply it, in which case, if you're a budding entrepreneur and you're thinking, I'll have a bit of that, then this is a good business to be in and ripe for exploitation. You can go and see if you can undercut and get the margins down. Okay, so there you go. There's our income statement. Let's have a look at their balance sheet. If I can find their balance sheet, going the wrong way, sorry. Yeah, no, we're on different pages here, sorry, so I've got to scroll right onto balance sheet. Here we go, here's the balance sheet, right. So we are looking again at the highlighted column, non-current assets. So these guys have got about £1 billion of non-current assets, and we're going to read these two numbers together. So they've got the property, plant and equipment and the lease right of use assets, which is more property, plant and equipment. It's just stuff they don't own. They've got it on a lease. So, you know, think about that photocopier in the corner. You know, maybe your company owns it. Maybe they got it on a hire purchase, for example. So we're going to read those two numbers together, and that's basically it. So, and that's not big for a company with a 2 billion turnover. So, you know, if you think about it, you know, they may own their warehouses, but probably they're going to lease or rent a lot of their warehouses. They may own their forklift trucks, but maybe they lease them as well. So, you know, they don't need a lot of stuff. They do have quite a lot of inventory. As you'd expect, they have people who owe them money because they sold them, and they've also got about £500 million of cash sitting in the bank. And so they've got another $1 billion of current assets, things which are cash or going to become cash soon. And if you add those two together, you end up with 2 billion in total assets. So there's the assets of the business. Current liabilities, things they have to pay soon, is basically their suppliers. So the suppliers that they bought, and you'll notice that if you compare the current assets to the current liabilities, liquidity just doesn't look a problem. In fact, they could got enough cash to pay their suppliers immediately. So these guys, liquidity really not an issue. Very, very comfortable doing business with them. Their liabilities are really around the leases. Okay, so you can see that these two numbers, these are the lease liabilities, and that will drive the interest that we were seeing in the income statement. There's no debt sitting here, so there's no kind of, you know, interest on debt. It's interest on lease liabilities, and that's absolutely fine. So really, you know, these guys, you know, I mean, the balance sheet is looking pretty strong. Total liabilities are $1 billion. on total assets of 2 billion, leaving them with 1 billion in net assets, so just under 1 billion in net assets. And that billion in net assets is a little bit of investment, but mainly driven through retained earnings, so that profit being reinvested back into the business in order to fund future growth in the business. So, you know, I'm looking at this balance sheet and I'm thinking it couldn't really be a stronger balance sheet. You know, this is a really solid company, you know, very, very strong, you know, almost bulletproof balance sheet as far as I can see. This ESOP, I just mentioned that's the employee share options. I don't know what the P stands for, you know, profit share or something like that. Reserve is basically saying that the employees are also getting a benefit from share price. And so, you know, there's a big incentivization probably going on. If you work at Howdens, you know, you'll be part of that share option scheme, the opportunity to buy shares in your business. So looking pretty good. Cash flow, here is our cash flow. They so here's the sort of the core cash flow, so very cash generative. Profit, add back the depreciation, these two numbers here, and we get basically the cash flow in the business. There's a little bit of a movement in working capital, so we like to just keep an eye on this, especially of companies like this. So for example, you know, they've got more inventory than they had. They're growing, they've got more inventory, but they've got cash tied up in that inventory. They're growing, they've got more people who owe them money, and that means that they've got less cash, and they have got more in their suppliers, and those sort of numbers then sort of slightly net out. We just might want to keep an eye on that, because, you know, if this company, if this number is growing significantly, often it's an indication of a company is struggling to pay its suppliers, and therefore, you know, obviously if a company stops paying its suppliers stop supplying, and then it becomes game over effectively. So it's not a problem for these guys. I think that's very much driven by their, you know, the growth of the business, and as we said, they've got enough cash to pay their suppliers like that. So really, you know, liquidity is not an issue for these guys. But if you are looking at other companies, just keep an eye on that. So in terms of the kind of the core cash flow from operations, generating cash, very, very good. Little bit of investment going on, that's fine, not a huge amount. They don't really need to do a lot of investment because they're not a capital intensive business. So, you know, if you do a sort of return on capital employed, you'll be ending up with, you know, 33%, for example. You go, wow, 33%, but these guys are not capital intensive, so it's not really a relevant measure. And we can see that they are paying out some of those shares, dividend, some of that profit is being paid to shareholders, and also they are buying back their own shares. So those two numbers there are kind of what they're doing with the investment. And so, you know, in effect, they're taking that cash and they're returning it back to the shareholders, but they're still sitting on them. They got positive cash during the year, and they're building up their cash balance. There was a comment about, you know, are they going to face some problems? Here's the movement in equity. So just looking at this column here, this is the retained profit column. We can see there's the retained earnings at the beginning of the year. We've got the profit for the period. That's the profit. That's the unearned profit. Don't worry too much about that, but we can see very clearly share buybacks, and there's the dividends, which we saw in the cash flow, and that's, you know, two ways of returning money to the shareholders. Comment was, you know, whether these guys are going to survive, you know, if we do go into recession. Maybe I kind of, you know, cost of living crisis, you know, my mortgage payments have gone up, my energy bills have gone up. The last thing I'm going to be doing is, you know, buying a new kitchen. You know, so these guys may see a downturn, but I think they are, you know, they are very, you know, they're a very strong business, and I think that they are, you know, they look pretty bulletproof to be able to weather any storm. I would be very surprised. I mean, it would have to be a massively deep, dark recession to knock these guys off their perch. So they may see, you know, the cash flow come down, they may see the profits come down, they may even make a loss, but I think these guys are here for the long term. It looks a pretty strong set of is a pretty strong business to me. What we might like to look at when we're looking at the balance sheet, just go back to our balance sheet here, is so when we look at the working capital, we're kind of looking at comparing these, and how long does it take them to move their inventory. It takes them 126 days to shift inventory, which is quite a long time, but that's probably because there's a lot of shipping involved in that. Takes them another 26 days to get the money in from their customers. Takes them 73 days to pay their suppliers. So these guys, they negotiate hard. Again, get your negotiation boots on if you are dealing with them. 73 days to pay the suppliers, which basically means their working capital requirement is about 80 days. Okay, so these guys from cash in to cash out need 80 days. But they've got easily enough working capital, so they are well capitalized in terms of their working capital to be able to kind of to survive that 80 days, and it's down from about 87 days in the previous year. So these guys are they're ticking a lot of boxes. I haven't really found anything that is looks weak on their balance sheet or in their financial statements. Let's go back and look at their share price. So here is their share price. You'll notice the PE ratio, the price to earnings ratio, up in the top right hand corner, is about 11 times earnings. Okay, so that's that's cheap. That really is cheap. If you turn that upside down, that's a yield of about 10%. Okay, so that if you buy this company, you're getting you're buying something which is giving you a yield of 10%. Okay, the market capitalization 3.4 billion. The balance sheet is only about $1 billion, so there is goodwill in there, but you're really, if you're buying this company, you're buying the future income. This dividend yield here, this looks a really low number. I'm not sure where that number comes from. They paid out 134 million in dividends last year, and if you include the share buybacks, which was another, I think it was 50 million from memory, that's a total of 184 million. 184 million on 3.4 billion is a 5% yield. Now 5% yield is pretty low in terms of dividend, but a lot of that is being reinvested back into the business, and they are growing. Just to remind you, their top line grew by 35%, which is a massive growth. So their earnings per share has grown from 24.9p to 53, which is a massive growth, which means that if you look at their price to earnings growth ratio, and there's a number of ways you can look at it in terms of including dividend yields and share buyback yields, it's it's really, really cheap. So I don't think they're going to keep up that 35% growth rate. So so I wouldn't kind of read too much into those numbers, but even if they come off the boil a little bit in terms of their profit and loss account and their growth rates, and even if they see a downturn, these guys are still looking relatively cheap. So I think I'm kind of I'm going to go back to our the dread pirate Buffett and so on, and just say, look, you're right. I think this looks really, really cheap. Yes, I think it is going to hit headwinds, but these guys are going to be there around for the long term. So I'm pretty happy with them. Just a final thought, Moeed. If we have a look at page 65 of these accounts, we can see our CEO and see how much the CEO is being paid. So here is the kind of the total remuneration, and you'll notice that Andrew Livingston, who runs the show, is basically paid about 4 million quid. Is he worth it? Well, I don't know how complicated the business is, but certainly I think he's running a pretty tight ship. I think that Paul Hayes, who's the CFO, the Chief Financial Officer, probably needs a bit of a pay rise, because he's, they really are, this is a good set of accounts. If you're working for these guys and you're interested in where you kind of sit within that, compared with that 4 million, you can find it out on page 81. So if we look on page 81, and I just need to find the numbers, here we go, staff costs. So it gives us the kind of the total number of staff. There is the total number of staff. It's just under 11,000 people working for the organization, who are paid collectively 553 million pounds, which means that the average salary at Howdens is 51,000 pounds. Now you can quickly work out, are you above or below average as an employee, and you can also work out that Mr. Livingston is paid 77 times the average salary. Is he worth 77 times that? Well, I'll leave that for the pundits to work out. So there you go, Moeed. That is my analysis of Howdens. I hope you found that useful and interesting. I think it's this looks a great company and certainly one which I think would be worthwhile investment. You may not see immediate returns, but I think this is a really good example of the fact that the UK, generally speaking, is cheap right now. There's lots of stuff out there which is just cheap. It's cheap for a reason, but it's not going to be cheap forever. So I think this could be definitely part of a nicely well diversified portfolio.
Thank you for that. And interestingly, the CEO for Howdens is paid his payments actually his salary is very similar to the CEO of BT, British Telecom, which is a much larger, more complex business. So interesting to see that he's being paid on a similar basis. So we'd love to hear everyone else's thoughts. I did promise to share with you how you can submit a request for a company you're interested in, and here's how you do it. It's very simple. All you do is in any one of our videos, leave a note in the comment section. Tell us the name of the company you're interested in and a bit of information about why you're interested in that company so that we can answer questions that are relevant for your interest. So if you just do that, that will you'll get yourself on the list there, and we will publish your analysis as fast as possible. Don't forget to like and subscribe and hit the notification button so you get notification of a company we analyze, especially one that you've requested. And if you know people who are interested in companies like Howden, for example, whether they're thinking about selling to the business like this or investing in them or even joining them in their career, do share this video with them, because this analysis will really, really help improve their understanding of the business. Until the next video, thank you, Ted. Thank you, everyone. We will see you on the next video.
Good to see you, Moeed. Catch you later.